to build an investment portfolio that the basic of it, to make yourself as your own fund manager. All right. So basically right now, okay, what I'm sharing with you is the basic way of asset allocation strategy. So along the way, when you find that, okay, you need to have some, like improvement or maybe reviews, you can base on this, okay, basic way of asset allocation and do some amendment. All right. So basically here the strategy use 50-50 using bond and stocks as the portfolio. So it's a life cycle investing with Merrill Lynch lock clock and also strategic and tactical allocation. So these strategies can help you to choose the type of investment and also determine your asset composition and review and rebalance your portfolio as well. So 50-50 ratio, bond and stocks, which means that if let's say you have 100,000, you're going to put like 50,000 into bonds and another 50,000 into stocks. So here are the things. There are bonds that you need to pick, okay? So not all the bonds that you can invest into it at the right cycle, okay? So stocks also the same thing. So stocks generally we all know is much more risky asset. So if let's say you think that it's a bull market, that's where you can start to look into some of the higher risk stocks. So to maximize that, if let's say you start to see like there will be a correction is coming, probably you can look into some of the structured product. So let's say like structured warrant or maybe options to hedge on the to hedge on the downfall or maybe the correction during that time to reduce the losses that you could incur during the stock market crash, okay? So bond side also the same thing, okay? You have government bonds, you have company bonds, okay, like corporate bonds, that was what we call it. You even have like commodity bonds as well out there. That's why these are the things you need to look into. So basically, start from now. Okay, what should we look into? It is that in the Intelligent Investor, the book actually by Benjamin Graham. So what he advised is the defensive investor to allocate their money to high-grade bonds and blue-chip stocks. So what do they mean by high-grade bonds? It can be AAA rating. Like there's a lot of rating company out there. They are rating some of the corporates or maybe the country bonds as well. So some of the country bonds can be rated at AAA, some of them might not be AAA. So if let's say we take a look into some of the bonds are in the market, so what we can see is that AAA bonds in the market. So what can we find from here? So if we have this, let's say we look into this Federal Reserve Bank of St. Louis, okay, so this is a state bonds. So state bonds is rated at AAA, so which means that is at a lower risk, and these are things that you can look into. So what are the pricing of it? You can see the pricing of it is about 15.27 during 1982. So right now slightly moving back up higher. So it's normal sometimes bond price are moving up slightly higher during the development stage. So when it's developed, the price will start to go down lower. So this is the Moody's Season AAA corporate bonds yield, okay? So these are the things that you can look into it. So some of the bonds, there are a lot of bonds out there, you can check it out. So other than this, let's say we have like, if we look into Bloomberg, okay, let's say top AAA bonds in the market. So if we look into top AAA bonds in the market, so there are some of the bonds out there which is like BX, okay, the top AAA rated commercial bonds, property bonds. So like I say, it's not just about corporate, it's not just about government, it have these commercial property bonds as well, where this company, they use their property at pledge into the financial institution. So they use that to create a bonds. So it's something like REITs, but it's a bit different is that bonds, they actually pay out a fixed dividend or maybe the interest out to you. So other than this, okay, you have like all these Blackstone, okay, and also you have like other AAA commercial mortgage bonds as well. So you have to be careful with mortgage bonds because it's like a 2008 time. That is the time where the financial crisis, okay, the debt crisis. So these are the mortgage bonds that actually flooding in the market during that time and caused the market to fall. So right now, I'm not sure whether the market has changed. So you have to do some of your studies, okay, into all this, all right? So next one, let's come back to this, okay? So these are the bonds that we have. So other than that, a simple option is to invest 50% of your portfolio in stocks and remaining into 50% in bonds and adjust the mix of that. So let's say about like 5% difference of this ratio. So in response to changing market condition on this as well. So you might see that during the bull market, or maybe the bull market is coming, rebound market, you can allocate slightly more into your stocks, okay? So like he said, blue chip stocks, in Malaysia wise, we have a lot of blue chip stocks, let's say like Maybank, Nestle. Nestle probably a bit too expensive for you to invest into it. You might think that way, but along the way you can see Nestle is actually gradually moving up higher and higher. So it's some of the good investment you can invest into to retain, okay, or maybe to protect your value of your portfolio. So it seems like $100 over, like last time during $50 over, everyone was saying like very expensive, but one of my clients, he invested into Nestle and the profit was really good. Right now about 130 over ringgit. So there's like more than 100% of gains from that. So it does looks like it's expensive, but the appreciation is there. Same thing goes to what you call it, like buying properties last time. So last time, if let's say you invest into properties like in those like really hot area, let's say like maybe like Damansara or maybe in KL, the resale value are there. And the price appreciate actually much more faster, and also there are not always say guarantee, but the demand for this kind of property in this zone is much higher than the rest that is outskirt, or maybe you buy somewhere in Cyberjaya and things like that. So that's why you sometimes you pay slightly more, okay, or maybe more expensive into stocks. It doesn't mean that it's not good, okay. So same goes to back to the thing, okay. You are not buying vegetable in the wet market where you want something that is cheap, then is good, okay. Cheap, it doesn't mean good, okay. So expensive one, because this is investment, is not buying vegetable or maybe buying meat in the market, because if the chicken you eat already and then you just went into Alam Sekitar or maybe the Indah water side, okay. So that's why these are investment. Don't mind with the value, whether it's pricing at a high price, but most important is that you need to find something that is worth it, okay, or maybe is below the intrinsic value, like how I show you a few days back, okay. So that's why all this you have to do adjustment. So if you find that the blue chip stock right now is not moving that much, now is the bull market, you want to get a bit of risk, okay, get more returns out from there, you can allocate some of your stock proportion between like 25% to 75% according to the market condition. Let's say bull market, you put in 75% into tech stock, maybe like AI stocks, okay. Right now AI stock is going down. A chip maker, okay, basically NVIDIA, all this, they are going downwards, having a retrace. So you might thinking that, okay, this AI stocks, okay, is going to have a rebound that is coming up. So you can allocate 75% of your portfolio, stock portfolio, into all these AI stocks, okay, into tech. Then 25 remain as blue chip stocks, let's say like Coca-Cola or something like that, right? So these are the things that you can do. When you find that the market is at the peak, then what you can do is that change, okay, the 75 and 25 ratio. So changing blue chip to 75 and also the 25% as a whole as tech. So these are the things that you can do. So at least when a correction comes, blue chip stocks have lesser tendency to go down lower, okay. The fluctuation, volatility, not so volatile. So the losses you make in the stock market can be reduced, okay? So at the end of the day, making losses in the stock market is normal. Like how Warren Buffett say, he always use the benchmark of S&P 500 or maybe Dow Jones Index. Why he do that? He's not comparing just on the return. If let's say Dow Jones or maybe S&P 500, they have a positive returns, or maybe during that year they increase by maybe like 5% or 10% or 20%, right? So at least if your portfolio is able to outperform them like maybe 30%, then it's good. On the other side, if the S&P 500 or maybe Dow Jones goes down, let's say 10% or maybe 20%, but you are only losing like 5% or maybe 11% out from there. So you still outperform the S&P 500, okay? So those are the benchmark that you need to do. So benchmark is not just about how much return that you need to compare. You need to compare with the downside also. If they are losing, overall market is losing money, right? So if the whole world are losing money and you want to make money out from there, yes, can. Doesn't mean that cannot, but that one require more trading, okay, short-term trading out from there. So if maybe use of some of the put options or maybe like short selling, you know, those kind of things that which require higher techniques and also knowledge to look into it. But if let's say you are not looking into that, going in and out, you don't want to every day, you know, going in and out from a market, you just have no time for that, then you have to actually benchmark that and see if losses incurred during the market, everyone is losing money, you are losing lesser, that is a plus sign, okay? Unless you are doing, you know, business with Martian or maybe invest into some of the company doing business with Martian that is not affected on Earth, all right? Then you can do that, okay? You can have that kind of expectation basically. Well, so that's why. Simply put, the higher percentage, okay, of these stocks in the portfolio and the higher the risk and also volatility, but also the higher the expected return in long run. Because you're putting into higher risk, right? So you need to expect higher return. If let's say you put in something like the risk is like you have 80% chance of losing that money, and also you have like maybe 50% chance of making like 20% only. So if you're having the chance of losing 80% of your capital and having a chance of making only 20% out of your portfolio, then it's not matched, okay? So these are things that you shouldn't look at it, okay? Some of the example of portfolio allocation is that income portfolio, usually how do they allocate their asset, okay? So they show it here, income portfolio, usually 100% bonds, plus 20% or maybe like 20% stocks or the 80% bonds. So we can see that they put more their money into bonds, okay, instead of like stocks because it's income portfolio. So they want to get interest, okay? They are getting interest every year so that they can use it to, you know, to build some of the things, right? So that's why they emphasize on bond, either 100% of bonds or maybe like 20% of stocks or maybe 30% of stocks and 70% of bonds. But if let's say balanced portfolio are usually, it can goes from 40 to 60, 40% stocks, 60% bonds, and also can be like 50-50 as well, or maybe slightly more for stocks or bonds. So if you want to have a bit of management, you know, to find like when is the best time to invest into it, then you can do some adjustment and also review along the way. Then you can actually build your own balanced portfolio. So for example, let's say market is not that great, then it's going to be bad or correction. You can move your portfolio into more focus more on bonds and lesser on stocks. And if let's say you find that right now not so sure, then you can put as 50-50. But if let's say you find that, okay, bull market is coming right after pandemic, everything should be recovering right now, then you can put 60% of your ratio into these stocks and also 40% at bonds. And if let's say you find that, or you can jump between it, okay, or maybe you can put it like a growth portfolio. Growth portfolio, which means that you will have a higher, higher risk of it, because majority of it, they are going to put the money into 70% stocks or maybe 30% bonds or maybe 80% stocks or 20% bonds, or maybe even to the extreme 100% stocks, okay? Those are growth portfolio. So how do you know that which one you should put into it? Let's say, for example, if let's say you are building a retirement fund, or you need to check the time duration. If let's say you have lesser time right now and how much you want to have during your retirement, then you need to go for balanced portfolio, because you would not want to lose your savings and lose your savings and put into at the end of the retirement you get nothing out from there, right? So that's why it's best to go for a balanced portfolio. But if let's say you want to have like an education fund for your children, So it's like maybe the next 10 years, they are 8 years old right now, 10 years later, they are going to need to use this education fund. Then probably you need to go for maybe the income portfolio. So income portfolios is slightly more stable because it's lower risk. Majority of the bonds is actually, the money is actually put into bonds, right? So now and then you can shift a bit out into the stocks if let's say you find that market is actually bullish, all right? So growth portfolio I think is suitable for those who have already planned their retirement at their young age, maybe like about 20 over years old, 30 over years old. So you still have that kind of time, and also you can accept risk much more better than those who are in their late 40s or maybe 50. Okay, so that's why you still have time to recover out from there using the growth portfolio. All right. So some of the notes that you need to take note of is that to achieve this diversification, the 50-50 balanced portfolio is based on the idea that stocks and bonds usually move in opposite directions. So like a seesaw, if let's say stock market actually move up higher, then bonds price will goes down lower. If let's say stock market goes down, okay, then the bond price will move up higher. Why? Because during correction or maybe the market is uncertain, usually the big boys or maybe the hot money, they will channel their money from the stocks, okay, they take profit and then move into bond market for safety, all right? Or if you read a lot of news, right, you'll find that a lot of, hot money, okay, whenever the financial crisis is, then a lot of money will flow into yen, okay, to buy yen. So those are foreign currency. So right now we are just talking about like two asset class, okay, bonds and also stocks. So, but of course, it's not always that have a negative beta, which is not correlated. So you need to look into it. You need to do the comparison, see whether this stocks is actually able to, the bonds is able to go against, okay, the stock market price. Okay, so once you know that, then you can shift, all right? But it also happens that, the two assets can fall at the same time. So always remember, there's nothing that is totally no correlation between them, okay? So you can find those that is closer to the beta, okay, or maybe the correlation between these two asset class, all right? So if let's say you want to find something that is really very close to, that is not correlated to the stocks or maybe to the bonds, then probably you need to venture out into other assets, okay? Let's say, for example, maybe cryptocurrency, maybe commodities, or maybe some of other asset, okay, that properties, all right? So you find out from that, okay? So I leave all this study to you guys. So that's why this is a fairly simple strategy. It's 50-50. Everyone of us know how to use it. So it's only focusing equities and bonds. So without considering other assets, like I said just now, cryptocurrency, and also like properties, commodities, or maybe like business is also, is different. So try to use this 50-50 ratio first. Why? Because although it sounds very simple, 50-50, but there's a lot of studies that you need to look into it. Let's say, for example, bonds. What kind of bonds that you need to look into it? They are high-risk bond and also they are low-risk bond. But generally, bonds are lower risk than stocks. So when you look into stocks, what kind of stocks that you want to invest into it? If let's say you find that, okay, you don't want to do all the studies, okay, which company that is better than others, what you can do is that you can invest into ETF. So those are stock market as well. So you invest into ETF, those ETF related to AI chip makers, or maybe those ETF that is related, the underlying asset that they are using based on EVs, right? Or maybe some of them, they are based on like properties. So you can invest into all these ETF, okay? So you find the best way out from there. Study this first. Start from a very simple method, then slowly grow from there, okay? Don't suddenly just jump to like, oh, I want to have property in my portfolio, I want to have like bonds in my portfolio, I want to have stocks in my portfolio. Oh, and also right now cryptocurrency seems like it's a hot thing. I want to include cryptocurrency into my portfolio also. Then there's too many things for you to study that it could be very overwhelming. So especially for cryptocurrency. Cryptocurrency, how to set up a wallet, okay? And also which token that you should buy, which exchange should you use? If let's say you want to liquidize, okay, how do you move the money back to yourself? So these are the things that you need to take into account, all right? So Next, we look into the life cycle of investing. So right now, you know that like how to allocate your portfolio, like 50-50 at the moment, put it as a balanced fund. Next thing is that allocation, okay, life cycle investing. So first thing, we look into type of investment: stocks, bonds, cash, and also real estate. So cash, usually we try to, like I said before, let's say you put like 100,000, maybe you reserve like 10 to 20% of your cash for your portfolio investment. So if let's say there are anything that you want to, shift from bonds to stocks, so stocks slightly higher price, then probably you have not enough money out from there, you can utilize this 10 to 20% of cash reserve for your shifting of your portfolio, okay, portfolio rebalancing we call it. All right, so first thing is allocation strategies. People in their prime with a stable job may have different investment preference from the people planning to retirement, okay? So you may tailor your investing plans according to your stage of life and living circumstances. So these are the things that's why I say you need to set the objective and also a timeline first. So generally, it's always about education fund and also retirement. So in the future, okay, parents might want to set up a marriage fund or maybe wedding fund for your children as well, because nowadays I found out that a wedding is very expensive, okay? So it could easily go up to like 100,000, with 100,000 including like you need to have a property out from there, right? So that's what we Asian always think, okay? You need to have a property so that you can get married, you can stay inside there. So things might change in the future, but I'm not sure. But if let's say you want to get ready for marriage, wedding dinner, where do you want to plan it, okay? And also like photo shooting and also preparation of all those like invitation cards and maybe some other things. There's a lot of things. So whoever have already got married, okay, you can share your experience with me, okay? Or maybe any one of you have very good experience in wedding or having marriage, then you can let me know as well, okay? And also what you should do, okay, after, if let's say you go into a divorce, okay, how do you plan your, how do you plan your financial, okay? If let's say like you need to split the assets or your wealth together with your ex-wife. So these are the things that we need to look into it as well. So it's not just like, not every marriage is always happy ending, okay? So, well, yeah, so that's just out of the topic. So right now, come back to this, okay? Simple version, okay? So what they are saying is like 100H rule. So what is this rule over here? So formula commonly used to determine the percentage of stocks an investor should hold is always 100 minus your present age times 100%. So let's say, for example, right now I'm 35 years old. So which means that 100, I need to, let's say 100, I minus my 100, let's say 100 minus 35, then times 100%. So is 100%. That doesn't make sense. So 60 is still 65, all right? So the people are living longer right now, okay, thanks to for the medical advancement, and also the equation can also be adjusted as follows. So the percentage of stocks as investor should hold right now is, let's say for example, 110 minus your current age times 100%. So this is a detailed guide of life investing, okay? So 100%, yeah. So Burton G. Malkiel, a Wall Street professional and also economist, believes that young investors with a long-term investment horizon may be more willing to take risks than older ones. So that's why he suggests asset allocation for different age group in his book of A Random Walk Down Wall Street. So what he say over here is that at mid-20s, okay, usually, how is your lifestyle like? Fast. Everyday work, and then like having time with your friends or maybe with your families, and also like hanging out with people and work again, have a bit of your own time. Even games, you can only play like 1 hour, which you usually don't restrict yourself when you're young as well. So that's why these are the lifestyle for mid-20s, right? Fast, aggressive, with a steady stream of earnings because you are working out there, and also capacity for risk is fairly high because you think that is YOLO all the way, right? So of course, you need disciplines of payroll saving to build your nest egg also. But well, nowadays I don't see like a lot of youngsters or maybe mid-20s having this kind of discipline. Even for myself, I mean, for myself, 20 over plus, I do have discipline on that. So I know that my money is going somewhere. So what I did last time is that every month I will allocate like 10% of my salary that pay out. I'll put it into my trading account, because the trading account is very tedious if let's say you want to withdraw. So at least you need to wait like 3 days. So it's not like instantly I can access to those money. So another 10% I'll just put as saving. So these are the way that I actually control myself for money. Or maybe right now there's a lot of way for you to do, put your money into saved without you using it or spending it, is by investing into golds like Touch and Go. You can actually buy golds as low as 10 ringgit in the Touch and Go app. So those are the things that you can look into it. Okay, so I'll come back to this. Okay, mid-20s, usually how you should actually allocate your funds. So 5% of cash. So money market funds or maybe short-term bond fund, okay, average maturity 1 to 1.5 years, which means that it can be FD as well. Okay, so another one is bond and bond substitutes. Okay, what do they mean by substitute? Also over here is that you need to allocate 15% out from there. So you can see right now for younger generation, you don't have to, not younger generation, when you are mid-20s, you don't allocate that much in bonds, right? Because bonds is not growing that much, and also it gives you income. Okay, so that's why which are no load high grade corporate bonds fund. So some treasury inflation protection against the securities, and also foreign bonds or maybe dividend growth stocks, also a good choice for you to look into it. So those are the bond substitute, okay, dividend growth stocks. So which means that they should put it this way, growth dividend stock, because you need to look into growth first. If let's say the capital is not gaining, the valuation is not gaining, you're taking the dividend, is not going to be working, right? So imagine the price is going down, how many years of dividend you need to collect to recover that losses, right? So that's why. So that's why right now we have like 5% of cash, 15% of bonds or maybe bond substitutes, which is like those growth stock, which is like blue chips, all right? And also 70% into stock market. So one half in US stocks with good representation of smaller growth companies, one half international stocks, including like emerging market as well. So these are the things that you can look into it. And of course, maybe 10% into real estate, real estate such as, let's say, you don't have, because mid-20s, right, you don't have that much of money. So if let's say you don't have that much of money, so what you do? You cannot buy properties, right? You can go into REITs, okay? You can go into like property-related ETF. So these are things that you can find out, okay? So you can see mid-20s one are more higher risk, okay? So you can put in like 70% into stocks and lesser amount, 15% into bonds, maybe 10% into real estate, okay? And 5% as cash, or like FD, okay? Some sort of like that. So if let's say you are late 30s to early 40s, all right? So late 30s to early 40s, like it could be like 36 onwards, okay? So which means that next year I'll be in the late 30s, all right? So these are the portfolio that I can use. So usually the lifestyle, midlife crisis, okay? Already having that, all right? For childless career couples, okay? If let's say you don't have children, and also capacity for risk is still quite high at this moment. So risk option vanishing for those with college tuitions looming. So when your children, you have a children, when the tuition fees, you need to pay for children tuition fees, that's where your risk appetite goes down lower, okay? So those are the things that you need to take note of, all right? So how much of percentage you should allocate? 5% into cash, and 20% into bonds and bond substitutes, and 65% into stocks, and remaining 10% into real estate. So what we can see here is that stocks allocation is slightly lower, and also bonds move up higher, and real estate remain the same. So these are, you can see that is less aggressive, okay, for late 30s and early 40s. And also for mid-50s, basically you need to prepare. Basically, not to say you need to prepare. The things that you need to understand is that, oh, I'm going to retirement in the next few years, right? So if let's say I want to maintain, what kind of lifestyle that do I need to have? Let's say you are a C-level in a lot of when you are working in your company, right? So you are driving BM and every 5 years you change car, that was your lifestyle. So do you want to downgrade your lifestyle to drive a Proton, or maybe you want to maintain the lifestyle that you can actually drive a Continental cars? So you need to think about that, but of course you need to be feasible, okay, reasonable. So usually at this stage over here is that many still reeling from college tuition because you still have to pay for your child. And also, no matter what the lifestyle is, this age group must start thinking about retirement and the need for the income protection as well. So if you want to maintain that kind of lifestyle, so what you need to do is that you need to have income from there. If you go into retirement, basically you have no income, so you need to build something that gives you income, at least like maybe a year. Then you can cover a year of your expenses, and also or maybe for expenses like maybe at this time probably you won't have commitment, or maybe just left a bit of commitment for your property mortgage, right? So these are the investment portfolio you should look into it. 5% cash also, 27.5% bonds, and also stocks like 55%, and also real estate 12.5%. Why they still put stocks much more? Because you are preparing for retirement. If let's say is your retirement amount is like you need to have like 10 million, right? So it's not there yet. So you need to actually be slightly more aggressive, put into stocks. So you cannot put everything into bonds. If let's say put everything into bonds, the inflation might eat that up, okay? So those are the things that you need to look at it. So late 60 and beyond, very simple. Basically right now you're enjoying leisure activities, but also guarding against like major health costs, like paying your medical. Basically you eat medicine, or maybe you eat those tablets more than you eat rice at this time, all right? So little to no capacity for risk. So basically right now is that you would think that why do I need to make that much of money? I'm going to die anyway soon, okay? Because I might be dying tomorrow, I might be dying 10 years later, right? So what you can do is that you still need income, right? So that's why put 10% into cash, okay? For any, you need to go for a medical checkup and stuff like that. Then bonds and bond substitute 35%, stock 40%, then real estate 15%, okay? So if bonds are held outside of the tax favor retirement plans, tax exempt bonds should be used, okay? These are, I think, the US side. So Malaysia side, we don't really have that, okay? So these are the four stages of, individuals that you can look into. So you see yourself, okay, where are you right now? And also your goal for your retirement plan. How much money is there, how much far away that it is, okay? If let's say 0, then you need to start it right now, okay? So I'll stop here for the asset allocation. Next, we will talk about Merrill Lynch clock in the future. So stay with us with Klever Stocks, and we will look into beyond the headlines after this.
Klever Stock, the ultimate financial insight for everyone.